meetup, and welcome to the 9 cities that are featured. I'm not going to name each of them, but welcome all. This is hopefully the first of many events we'll put on. Our goal with these is really to bring communities of investors together to share knowledge and opportunity and network with everyone. My name is Michael Frank, and I'm a small real estate investor personally, and as an LP. But my main role tonight is as an investor to Plum Lending, who has generously supported the start of this group. They are the same mind as I think most of us in wanting to be generally value-added leaders in the space in helping accelerate CRE real estate and investment in general. Tonight, we're going to do a Q&A with Kevin Miller, the Chief Credit Officer at Plum Lending. But as mentioned in the event description, if anyone wants advice about funding their deals or seeing if Plum could be a good partner, the team at Plum has graciously said they'll consult one-to-one with anyone. So in addition to that, feel free to asking questions right now. You can also email Eric, E-R-I-C, at plumlending.com, and they'll actually help consult one-to-one on that stuff. Finally, one last piece of housekeeping. We want to do many of these events, and we want to share many stories from the community. So if you want to be a speaker and are doing cool stuff, please message me via Meetup. And yeah, we'd love to have you on for a future event. Now on to the interview. I have a number of questions for Kevin, but we want to feature your questions and thoughts as well. So ask questions in the chat as we go if you have stuff you want us to drill down on, or that you disagree with, or you just want us to talk about. And then, as mentioned before, partway through, we'll allow everyone to unmute and ask questions themselves. With that being said, I'm pleased to introduce Kevin Miller. Kevin's the Chief Credit Officer at Plum Lending. Prior to working at Plum, Kevin was a managing director and employee at a number of other CRE and investment firms, including Trimont Real Estate Advisors, Cohen Financial, Citus, and JP Morgan. Welcome, Kevin.
It's good to be here, Michael. I think first off, as Michael indicated, we did have included in the meetup groups Tampa as well as Jacksonville. We recognize the hurricane there in Florida right now, and feel for the people who are there still. We have some employees who actually are in Tampa right now, so definitely understand those who aren't going to be able to make it to the meetup. One thing that we want to do at Plum is, it's one thing to say, we really want to send our thoughts and everything, but we also want to find a way that, for any deals that we close for people in those markets or properties in those markets, we want to find a way that we can donate a portion of our fees and income to the food banks in those respective markets. So we recognize it's not easy. I've sat through and been through a couple of hurricanes myself, so truly understand it.
Thanks, Kevin. I feel the same way, and that's great. To jump into questions, I guess the first one, which I think is on everyone's mind, is we're coming out of COVID. The Fed's been raising rates for a couple months and has indicated there's probably a couple more. Right, SOFR's gone from 0 to almost 3%. Yeah, how does this affect the opportunities you're seeing in underwriting from your role?
It's interesting to see where rates are right now. I mean, I think we had a uptick quite a bit again yesterday, almost up to 4%, I believe. It was 390 something on the 10-year. We did see those pull back again, thankfully, to I think we're somewhere around a 3.74 10-year rate. You definitely have a little bit of an invert in the yield curve, with the shorter term rates still being a little bit higher than your longer term. We are seeing that, this increase, we're hearing different things from the people we work with as far as, capital sources we connect with constantly, as well as real estate owners that we're also working with. There's mixed opinions. We have a capital market call that we do internally here at Plum, which has senior individuals who are executives at large name real estate groups. Some of them were BlackRock, some of them were other tech type companies as well, and to get their perspectives. And through those, we, as mentioned, see the differences. I mean, there's some groups that we interact with, some life companies, they're showing that on the equity, their equity desk is telling them that, be thinking maybe 3% 10-year, which is quite a bit different than where we have seen rates go. Their view is, I guess, the Fed's kind of, moving a little fast, and that the items out there will catch up. And maybe by the end of the year, we do see a continued decline in 10 years. I'm not saying that's our perspective or my perspective. I mean, personally, I see rates kind of, increasing a little bit more. I think there could be a chance they could pull back, towards the end of the year. But when you look at where the historical average of the 10-year, I think it's, on a historical basis, I think it's around 426. You look at where I believe the 10-year was back in the early 2000s prior to the Great Recession. You're talking, I believe, 10-year, if I'm not mistaken, was in the 4.5, 480 range. So it's not like we haven't been here before. Fortunately, where rates are, in the 10-year coming up after the Great Recession, you did see a number of different lenders try to find ways to prevent what happened in the early 2000s from occurring again. We saw, LTVs pulled back. When you look at a lot of the issuance in the Freddie series on the multifamily side, you look at where life companies kind of set their thresholds for their better rated deals and what they call CM1 deals. They set them at a 1.5 debt cover. So, that was really not pushing the debt coverages we were back in the early 2000s. When you look at the LTVs, the life company, GSEs and others had at 65, 70%. You still had, based on the math, you probably were still looking at 1.35, 1.4 debt coverages. We're back in the early 2000s. I remember constantly underwriting deals to 1.20. If we were pushing it, we may have been pushing to 1.15. So, it's different. There's an adjustment period that needs to be made. But the owners that we work with, we find are, they understand the markets. In some situations, we typically work a lot on the refinance side as well. And, fortunately for them, they've paid down their deals and there's not a whole lot of concerns with the refinance, maybe a little bit less of ability to pull equity out. Their debt service may go up, but there's not deals that are, not being able to get done in this market.
Are you seeing capital stacks look different than they did like 3 months ago in terms of leverage ratios, et cetera?
LTVs, as far as the leverage ratios themselves, I mean, we are seeing, as rates have gone up, some lenders have been willing to take a little bit higher leverage point based on recognizing that's going to correct itself over time. But at the same point, I mean, reality is most of the deals that we have seen have had amortization built into them. So, I mean, we're working on, a couple deals right now that were 2012, 2013 issuance in CMBS. We're looking at deals in this case. They have a, 16, 17 debt yield, a 45% loan to value because they've been amortized down over the last 10 years. And the rates, back then, now they were lower than where we are today, but they weren't substantially lower back in, 2012, 13, which is where you're seeing a lot of the roll off on 10-year deals.
That makes sense.
There are deals, that we are seeing more so for, floating rate deals that were done since COVID, where there is maybe groups having to reach out and get more, pref equity brought in, other private investors, family friends, or in some cases who are, matching them up with some of our mezz friends. So, to help get their deals across the line.
Got it. And are you seeing prices and multiples on the other side adjust down as a result of this higher cost of capital?
Not typically yet. I think that's, what you find is that's more of a lagging situation. Right now where it's still a little bit new. We are seeing deals that are taking a little bit longer to close. There might be a slight adjustments to purchase prices. But recognize where these deals were done before at lower rates, there's been a lot of, rent growth and other items that, have offset some of the other areas of concern. So, the cash flows of the properties are much more attractive today than they were 5, 10 years ago, just because of, if you look at rents, especially in the multifamily space. I think Freddie did a study here recently that think they indicated about 58% of the renters they surveyed had seen rental rate increases. You're seeing a little bit of that level off, I think, nationwide in July. Rent increases were, I think 10 basis points or down 10 basis points. So very flat. You are seeing, maybe the August data saying they may be dropping a little bit, but those are in the markets that had experienced substantial rent growth. Even in the markets that we looked at, there has been rent growth, but we haven't seen a whole lot of leveling off of, declining rents in those areas.
And you're speaking specifically to residential rents, right?
Correct, on the multifamily rentals,
Right.
residential side.
Mm-hmm.
So, I mean, one of the things that we, from a Plum perspective, we're not really lending that much into the gateway areas, the New Yorks, the San Franciscos, Miamis as much. We tend to really focus in what we call our Plum Select 80. And you see in those major markets, there's definitely been rents declining in San Francisco, New York, and others. But you haven't seen that as much in, the Columbus, Ohio's, where you have Intel, announcing the major plants that they're building, or the Columbia, South Carolinas, or the other areas that just haven't been as impacted by the liquidity, and they're continuing to see migration into those areas that are continuing to push rents and, a thing we don't deal with, but single family residential homes up. And that's just all leading to, more value creation in those markets.
Makes sense. So from the investor standpoint, do you have tips for sort of both closing loans easier and, right, I know Plum, whatever, talks to tens of new or hundreds of new borrowers every month. Basically how, if from the sort of my sponsor hat, how do I close loans easier, / how do I come really prepared to you guys?
Yeah, I think what we find is when real estate owners come to us with their information in a more consistent format, organized, that, either they have internally, you can tell they have folders set up where they have leases set aside. And, there's usually about, when we look at it, we're going to be looking for the main elements, the leases, everything that we can, support the real estate itself. So the more information that's provided to us at the initial forefront, appraisals, if they've been done before, engineering reports or environmental reports, we know quickly how to go review those things and see if there's any things that could potentially cause an issue during the closing process. It's better to uncover those up front. As far as rent rolls and operating statements, as long as they're in more of a traditional format, if people have them in Excel, the underwriters love that because they're easily able to take that information and put it into their modules they use. Yeah. If not, if they're in more consistent,
you don't like PDFs of rentals?
If there are PDFs that are more traditional accounting standards, there's now technology around that can break up those PDFs and quickly put that into what we call more of a structured format. And that allows us quickly to go through that information. But, the main key is just the easier it is for the user, the lender, to evaluate it and take it and put it into our systems. We just find it helps get an answer back faster because we're just not having to do a lot of compilation. We're actually able to quickly, run it through our models and be able to get an answer back to our sponsors that are looking for their facilities, as well as if there's abstracts and leases that are done, that have been done in the past, if there's a way to take a look at those as opposed to reviewing the full leases up front. Depending on the property type, retail, there's always the hidden co-tenancy clauses. Office, you see termination options. So it's always good to have a sense of what are those more potential rights that a tenant have that could get them out of a lease. If those are made up front, they're going to be uncovered during the closing process. So it's easier to work around those and create a structure that makes sense for them than to have already talked to the rest of credit, and in that case we've kind of steered it in one direction, and then we're having to try to find another reason why we need to structure it a different way. So it's that time, and especially now where we're in rising rate environments and people are looking to lock rates, the quicker we can get information, the quicker we can give it answers back, that only allows, our owners to lock rates, much faster. And the last thing we want to do is once we commit and, have an application in front of somebody, we strive and we focus on certainty of execution. So if there's anything that could prevent a deal from being done, we try to figure that out up front. We may spend a little bit more time than a lot of other groups, but our view is once we say we're going to move forward, we're going to move forward.
That makes sense. So just we talked a little bit about sort of some of the potential headwinds, and you did a good job of sort of putting those into sort of greater perspective, but obviously like things are a little different. So are there opportunities you're seeing investors trying to take advantage of as a result of sort of the new normal, whether it's the new normal kind of coming out of COVID or the new normal with higher rates, et cetera?
I mean, there's definitely going to be those situations like those situations where, there are going to be assets and some owners that aren't going to be able to, obtain the financing. We have the ability to look for those assets within our proprietary systems and help owners locate those assets to some extent. It's one of those things that, these times, as long as you have cash and liquidity, we recognize that, unfortunately, a lot of the big equity funds have a ton of cash, which makes them ability to jump in. But we want to find ways that we can also help out the owners in, our respective markets, find ways for them to execute on deals. And if there's things that we can do to assist in that process, we want to do so.
One of the things you alluded to earlier is sort of this concept of the Plum Select 80, which I guess are 80 markets sort of Plum has really specifically targeted. I think the 9 or 10 cities that are featured in this group are 9 or 10 of those cities. Can you maybe talk a little bit about what went into selecting those 80 and why you're sort of so bullish on them?
Yeah, I alluded to a little bit of it already, but we find that in selecting those markets, we wanted to find those that are more stable, those that definitely don't have access to necessarily all the capital that maybe a gateway market may have, because we wanted to make sure we're providing value to these markets. These markets typically range in $1 million, MSAs $1 million to $2.5 million. We do have a few outliers because we still feel like they have been, in our view, overlooked by a couple of different, capital sources around the country. But traditionally, have a large regional medical center or medical center presence, state universities, state governments, those things that provide stability. We've also found that because of COVID, a lot of individuals have migrated to a lot of the markets we were covering by chance. It wasn't something that we had, expected that COVID would, feed people into our market 2 to 3 years ago, but we have seen that, and that's only made these economies even more stronger.
Got it. And then are you finding, someone just asked this, I think directly to me in the chat, what are you seeing about in terms of emerging asset classes? So they mentioned like short-term rentals and cannabis as two, but are you starting to look into those, and what's your perspective on how to kind of underwrite these asset classes that are just a little bit newer?
There are different ways of evaluating them. Cannabis is an interesting asset class. It is something that we have seen quite a bit of in the past year. There are Fed issues that you have to worry about that prevent a lot of the big banks from getting into them. We do look to try to find ways to execute on those in the situations that make sense. And, in those situations, it's something that we're not doing, holding those on the balance sheet. Those are things that we have groups that we have been able to find because we know people have been looking for those opportunities and looking for ways to finance them. A lot of even the equity funds haven't entered that space. So there's a niche group of potential, capital providers that we have come across in the past, 2 to 3 years as we've seen this expand even more so. The reality is traditionally the real estate's great. A lot of it's good, sound industrial buildings. So in the event that, something did go wrong, you end up with a great piece of real estate. But we have also even seen situations where, I think right now we're working with a couple individuals and finding, on more farmland and other stuff, not just from the real estate perspective. From a short-term rental, where we see these traditionally is more so where there's a portion of the rent that's, maybe they're either manufactured housing communities that set aside a number of, a portion of tenants for more
Yep.
short-term rentals, or maybe it's apartment buildings that, have a little bit more short-term rentals. Otherwise, I see personally them as more like hospitality assets
Mhm.
and really not thinking about what the rents are, but more from an ADR RevPAR basis and occupancy, and trying to see if there's a way to position it more as a operating business from a hotel type perspective, and would probably be treated more in line with hotel deals as it would be a multifamily. That's my viewpoint. I just
Makes
see them
sense.
operating that way.
Yep.
I spent a considerable amount of my time in Park City, Utah, the last 6 years, and that was
Yeah.
a market that saw a tremendous amount of growth in the short-term rental market, especially with all the ski. And I think that's really where you see a lot of these in more of the resort areas.
Yeah. So on an emerging asset class like that, like what you're saying about, right, ADRs and RevPAR and all that stuff makes total sense from a like a comps perspective. But the difference between that and hotels is, right, there's pretty significant regulatory risk in a lot of these markets. From an underwriting perspective, how do you, right, just because like I personally ski in Lake Tahoe a bunch, and there are still a lot of short-term rentals, but I think there's some cap or outlaw on new ones. How do you think about that as an underwriter or something like that that might be, yeah, just that's thinking about making a long-term, like, 10, 20, 30-year commitment to something?
Yeah, no, I think it's an interesting thing. I mean, it's one where if you fall into a area or a zoning that allows for it, there's even in the community I'm in now, there's certain areas that allow for it and do not allow for it.
Mhm.
I think having, some people feel that having that ability to have a short-term rental only increases the value of the real estate. The issue is, if my personal view is, if they're doing that robust, and there's that big of presence, I wouldn't be surprised to see more hospitality units go into those markets. And
Right.
you do
Then you have a
see
supply issue, right?
it's all about demand, supply and demand. And you do have Park City is a perfect place where there have been developments that have tried to go into that place to bring in more hotel units.
Mhm.
And you see a lot of the property owners, fight hard against it because they want to protect their property values. I think it's too early to say too much, but it is something we're going to see more and more of, I think, in certain localities around the country.
Someone else from the chat asked about your perspective on lending to hotels, and will Plum lend to hotel deals?
Uh, we definitely look at a number of hotel deals. It's been interesting to see. I think COVID, really brought out a lot of things that not everybody considered during, about hotels. If you look back into March, April 2020, at that point, I was, working with a number of investors that were looking to buy, this most subordinated tranches of CMBS deals that had hotels in them. They wanted to get access to the hotels because they saw tremendous value there. We knew that when we were evaluating those things that they would come back, and hotels have definitely come back. They probably were a little more faster to come back in certain areas and exploded in more of your resort areas. That being said, from a will we look at them, we definitely do. Traditionally, I think from our perspective, we're probably looking at debt yields somewhere in the 15% range, though. We're probably going to be looking, somewhere in, 50, 55% loan to value, with some type of amortization built into them, which is going to, probably insulate, from a risk perspective. But that's, hotels have a lot of risk in them. I think there's questions out there that do need to be considered. I don't think we've seen as much about wages are going to do. I mean, the increases in minimum wage, what's that going to do to the margins on the hotels? And we're seeing substantial ADR growth in a lot of areas right now. With us leading into recession, what does that do? And how do companies scale back? I mean, we've seen layoffs occurring quite a bit across the board and being announced. One of the next things to do is to cut back on travel. And already your group demand has been cut back quite a bit, since COVID. It's going to be hard to say that group really comes back I think your leisure will also probably be impacted quite a bit, as if we do get to a point where we fall into a recession. So I think there's definitely risk there, but there's also definitely a lot of opportunity, and there's areas that will benefit from the hotels. You have to be selective and understand the markets and understand the properties extremely well, and the comp sets.
Someone else in the chat asked about, I guess it's kind of a sort of market versus deal specific thing. And basically, if you're looking at a deal, um, are you looking at like a lot of market level stats, like net migration or whatever, or is this more around, or are you more just interested in like, okay, are there really good debt service coverage ratios and stuff like that? Because it's sort of hard to predict a lot of this sort of more kind of macro market level stuff.
Our models feed in data constantly from a lot of data sources that are out there. We evaluate it, we take into consideration. We recognize each property, though, has its own story. We also recognize data being fed in through, any group that's out there that's, has data. Having been in the industry and come through so much data in my background, there's things that skew, vacancy across markets, or, CoStar is a leading group that's out there that everybody knows about. Nothing against CoStar, it's just that when they have the ability for you to go into their data, which is great, and it's very helpful for lenders like us, that we're able to go in and understand if, maybe a 10% vacancy in the market is being skewed by a, 400,000 square foot building that has been, vacant for the past 30 years, but just happens to still show up in that asset class and is driving vacancy from, 8% up to 10%. And those are the ways that we really try to get granular when we're looking at it, so we truly understand the asset and take in consideration the market fundamentals. Definitely look at population trends that are evolving, household incomes, all the key demographic data as well as GDP. How has GDP been in this area over the last 10, 11 years? Most cases, it's been positive growth, but which ones have seen more? And where do we expect those to go in the future? But, we definitely recognize that if a property's throwing off a 20 debt yield, then, maybe there's something that speaks to why that is and the market's not. Although I will say I've evaluated hotels that no one would buy it on a 43% debt yield because it was in an oil market and oil prices were being crushed. So it's all about a lot of different factors that will drive.
That makes sense. Okay, so everyone here, we want to give anyone who wants to ask a question live the opportunity to ask Kevin a question live. So I believe you should anyone who wants to should be able to unmute and ask questions. So I have a couple more, but I want to give anyone here an opportunity to chime in. Let me know in the chat if there's any issues with doing that. This is always fun when people don't ask questions. Anybody? Okay, no worries. All right, so I guess the last question I have for you, Kevin, is so we have a few months left in this year. If I'm an investor or sponsor who's coming to you asking for advice about sort of how to navigate everything, what would you suggest?
It's definitely an interesting market where you're in right now. I would consider multiple financing options that are out there. When I say that, definitely evaluate whether a floating rate facility may be more suitable for you or a fixed rate, facility. It's all depending on where you perceive rates going. We have our views, but at the end of the day, we look to our sponsors to, make their decisions. We're not looking to pass our views on to them. In some situations, it's making sure you have, as I mentioned, it's to get deals done quickly. It's having the information in a crisp and clean manner. Look at lenders that may provide more longer term flexibility. So we have the ability to fund deals that are 25, 30 years, 20-year deals, which, will allow for, shorter term rate options. So we could do 5-year, 7-year options on a 25, 30-year type deal. allows people, if for some reason the markets do, rates do decline in the next 5 years, they have the ability to get out during certain periods of time, the last 90 days of those periods, fixed periods. Having optionality, I think right now is great. I'd be a little concerned about over levering in these markets right now. There is the ability, if rates do come back, having the ability to come back and, look for that. A lot of groups allow for supplemental loans. So if for some reason you're looking for more proceeds, but your business, maybe the numbers don't hit it today, I wouldn't be afraid of, taking some initial dollars today and then recognizing you can always get supplemental loans or additional advances somewhere in the future. So, it's a tough market. A lot of the lenders are, stepping on, off to the sidelines for now. We have seen that. A lot of the life companies did fill up their buckets, probably in towards second, third quarter, early third quarter, just because a lot of this widening of spreads there back in March and April kind of scared away the securitized markets, and they were able to jump in and take advantage of that and get some deals at some pretty good opportunities. Capital is a little more sparse right now than it has been. But at the same point, if the views rates are going to continue to increase, you have to do what you got to do right now. We're committed to trying to continue to get deals funded by the end of the year.
We had a couple more questions from the chat. This one is a funny one because I'm smiling because this one allows you to feel free to promote yourself as much as you'd like here. Someone says, what distinguishes Plum from other funding sources?
From a Plum perspective is when we focus on our 80 markets, we understand the people in our 80 markets. A lot of groups don't look into those markets or are uncomfortable with those markets. We truly get those markets. We have our direct capital, which allows us, and which we view provides us certainty of execution. Our ability to really get deals done. When we say we're going to do them, we're going to get them done. I think the people we've worked with in the past will speak to that as well. It's one thing for us to comment on it, but I think those that we've worked with definitely would stand behind that statement. We're also available. As a chief credit officer, I'm here weekends during all hours, and I like to visit with people before we get deals out. I want to make sure we have the ability to really truly understand the deal at hand and tackle any issues, understand the issues, so we can make sure that once we do get a deal under application, we can get that deal closed. It's that personal touch. It's direct lines to myself, it's direct lines to our CEO, our chief operating officer, and our team is here and committed to make sure we do what we can do to get the deal across the line.
Someone else asked, if you're sitting on a property to finance in the next year, would you recommend financing now to protect against a 100 to 200 point Fed rate increase, or would you risk it to see if rates drop?
I guess you look at me, I'm sitting in a credit hat, so that means I'm probably usually not the one who's wanting to take a ton of equity risk off. So from that perspective, I'm more, trying to find ways to protect myself than try to get the extra buck. If you talk to maybe someone on the origination side, they may feel differently than that. But, I do feel that when you do see where things are, I think there's ability to do something now. Definitely, evaluate their, can you stomach it today? If you can, I would. And that what I mean, if you can go ahead and put the facility in where rates are, you always have the ability to refinance in a couple of years. There's always optionality that you can have built into your deal as well if you're willing to pay for some of that optionality. It just depends on how you're looking at it. But, it's better to have financing to maintain a property than risk it and not keep the property to your, 6 months to a year from now.
Awesome. Well, Kevin, I think that's all the questions. Thank you so much for being generous with your time. Thanks to all the guests and people who chimed in with questions. This was a really fun first one of these. We hope to do many more. As mentioned, thanks to Plum. Email eric@plumlending.com if you have any questions about your specific deals. But thanks everyone, and we'll see you soon.
Thank you all.
Thanks, Kevin. Bye.